The first question is from Madhu Gupta from Quantum AMC, right? Does the platform re-architecture and modernize the legacy of MFRT architecture? Does ReArch modernize the legacy MFRT architecture?
Yeah, absolutely. Just think of it as we running business on a platform which is about 25 years old. That platform started, we started the build of that platform when SMS was just emerging in India in 1998-99. APIs were not a standard format for communication. Online banking had not commenced. WhatsApp had not existed. So that platform was built in those times. And obviously, we bolted on the ability to deal with all of these things on top. But that's like having a car where you've kind of ported the AC from some other manufacturer, the light from somewhere else, the cooling system from somewhere else. So we will now displace or rest the current platform and get into production with the new one. So it's absolutely bringing in a brand new, futuristic, current gen, new technology infused platform. The old one will go away. There will be some period of time when both of them will exist. They have to, because instead of waiting for 4 or 5 years and doing a big bang launch, we're going to launch it in 5 modules. So there's time when both of them will exist, but over a period of time, the old one will get sunset.
Cool. The next one comes from Nidesh from Investec. What is the revenue model and TAM of Consent Pro?
What is the revenue model and TAM of Consent Pro? So as far as Consent Pro is concerned, all of you have been reading the same articles that I've been reading, that DP implementation, all components of it, the big four will end up doing consulting. Consent Pro kind of products will bring the consent architecture. There is a large data discovery piece, and there is a large audit and compliance piece, testing piece, employee training, all of that is estimated to be a multi-thousand crore opportunity. Now, I don't want you to get led by all those numbers because we're not playing everywhere. We believe that for a large part, the large consulting firms and the large legal firms will kind of hold sway. But we believe that just the consenting part will be a several hundred crore business across the country. Why will it be? Like Amit illustrated, that today the mutual fund industry has about 6 crore unique customers, but those 6 crore unique customers have gone and opened accounts with many mutual funds. And if you take an average of 2.5 or 3, those 6 crore people have 18 or 19 crore instances of existing inside a mutual fund. If we speak 3 years later, this 18 crore will be at least 30 crore. Today, CAMS produces about, on a good day, 1.5 lakh new accounts every day. So we are incrementing our account count by almost 2.5 to 3 crore a year. Pricing is still not decided, so I don't know whether this will sell at 1 rupee, 2 rupee, 5 rupee per unit, but estimating that it sells at somewhere in that range. Just the consenting part will be a multi-hundred crore business. And again, like I said, we are very interested in building franchises. 3-year vision of non-MF is 400 crores, growing from 220. So we are planning to add 200 crores of heft to the non-MF business. Can Consent Pro become a 20 crore line? That's my desire. Will it be a 100 crore line? Not really. We don't expect that scale to happen, but can easily be a 20, 30 crore line in the next 3 years. That is the broad thinking about Consent Pro and what the potential market size could be. Will we go into other areas? We're preparing ourselves. We believe that we have great expertise on Oracle, for example, as a data storage medium and as a database. So will we get into data discovery, etc.? We're still thinking. We're not ready for it. We're still thinking. So think of it as us playing in the consenting arena. Think of that being a multi-hundred crore, or 300, 400, 500 crore business across the country. And for us to be entering with a desire to make it a 20, 25 crore business. That's broadly how I would put it.
I'd just like to add one thing. It's extremely very early to talk about pricing and all those things. I think as we speak, the first quotes are going out. Amit has sent out a few quotes. The consulting part of it will obviously be a fixed bid kind of a thing, but it also determines by the volume, right? Number of customers that are being serviced. So we will have to wait and see. But What seems to be emerging is activity-based, which is there is a fixed price per a particular customer levels of things, but it's too early to talk about consent. And in terms of market, absolutely what Anuj says is right, because you have newspaper articles talking about, several hundred, several thousand crores of market in which consent manager is supposed to have 1,000 crore market share, but those seems excessive as of now. We'll have to wait and see.
Perfect. The next one is from Supratim from Jefferies. The global tech sector has witnessed a massive sell down in the last few days on the back of AI tools. Why shouldn't AI disrupt the RTA segment as well as, which is also a software as a service?
Yeah, sorry, is this working? Yeah. When you think of RTA, it's a good idea, by the way, to think of it as software as a service. But I will tell you that it's a mix of a software that we have created for clients to ride on and use. It's complete digital infrastructure, which means that we provide the connectivity to stock exchanges, banks, payment gateways, fund accountants, courier companies, to all of them. The mutual funds don't have to do any of this, so we bring everything together on a common platform. And the orchestration of this entire thing is done by us, belongs entirely to us. So think of that as like an SI's role in a large software implementation arena, where we have thought of the process, we cook the training material, we do everything end to end. The processes are owned by us. Just like you saw one of the examples that Somendu gave, that we are trying to do something by matching your face in a video versus your static face taken from the DigiLocker. The decision, this entire design is ours. I could have done this through an OTP or something else too. Context of the industry is very important. Like I showed you when we were talking about CAMPS Lens, that we try to build this off a large language model, assuming that it will understand the words joint holder and nomination and transmission and all of that, will and legal guardian and those kind of things. And those kind of things have different meanings in different countries, in different places, and different contexts. So the industry context is most important. What the AI world is trying to do, they are saying that, look, if you have the industry context, then code and connectivity, which used to take years, I will not have programmers write that code. I will enable machines led by AI to write that code, which is also what we are doing in the re-architecture program. Our belief is that the components of digital infrastructure, the entire process design, context about the industry will continue to remain moats for a very long time. Conceptually, if you ask me the question, oh, is this like SaaS? That thing is also like SaaS. Can it get disrupted? You can come to a very simplistic answer that yes, possibly it can be. My personal belief is that the number of modes are far beyond what you see. And like I said, that unless they have the industry context and have the SME ship that we built over 30 years. You, for example, know that in India, there are other players who've claimed to be digital RTAs but haven't won a single contract. They've been around for the past 5-6 years. There was a large JV between a large French firm and a large Indian group which tried to win business for 8 years. They tried to build something which resembled a platform, but they did not have context, they did not have SME ship, they did not understand the nuances, they did not have knowledge. So I think all of this has to come together. I don't want to sit here and demolish any possibility of a threat and say impossible, they're never going to win. I don't want to say that. Our view remains the same. It's a complex process, known to very few people. It's a small niche, and therefore somebody has to take a decision to get into that niche, be as able as we are, and then do the same thing. The LLM that we were talking about is one of the top LLMs in the country. So I will not keep naming them again and again. You've seen enough content from us on who those guys are. We could not build CAMPS Lens on what they had. It was impossible to build it because that product by itself does not understand the word, let's say, what does will mean, right? It has to be contexted. What does transmission mean? It has to be contexted. What does joint holder mean? It has to be contexted. What is onboarding? It has to be contexted. So you need all of that. Somebody with huge determination and their eyes on this market. And I will also tell you that our deployment of AI is now almost 2 years old. The first 6 to 9 months, 1 year of experimentation, the last 1 year of very, very serious work. So therefore, the advantages that accrue from knowing the context and getting AI and building all of this out is something we are already doing, and the rest we will see what the market has to say.
The next one, Anuj and Ram, is from Anil from the Fine Print. What are some of the developments related to KYC in GIFT for NRIs, inbound as well as for outbound funds, and what are the future plans?
See, I'll give you a very broad answer. GIFT, as you know, is envisaging, obviously, an ability for customers or investors to come in and get onboarded inside of GIFT, not by the Indian domestic regulator. IRDA has a system, RBI has a system, PFRDA has a system, and SEBI has a system, but not to rely on those systems, but to have a single onboarding to create the opportunity for that investor to buy any of these products, to invest in any of them. So GIFT will create on their own products which are being sold there, a single onboarding mechanism. There are offers to set up KRA kind of agencies there. We are examining them closely. So you will hear something from us in the next month or two on how we intend to take it. We believe it's a large market. It will be a very large market. The predilection of the Indian living overseas to invest in India, and the Indians living in India to invest overseas through instruments available in GIFT, both of these are momentum causing events. So that momentum will be experienced, and you will see us play some role, or a large role, in the onboarding facilities being built out in GIFT.
Okay. The next one is from Madhu Gupta, once again from Quantum AMC, and this time it's on yields. Are AMCs beyond top 3 at parity with respect to RTA yield to avoid a repeat of the steep pricing in the future?
The short answer is we don't see any risk from that. In fact, one of the analysts sitting in this room has put out a very good report on why this is less of a risk for CAMS going forward. And what has been done is, based on the fund accounts published for last year, number-based database, we have seen what is the difference between similarly sized customers, right? We always say it's what is a fair comparison of similarly sized customers. And the conclusion is the risk is very minimal. It is not to say mathematically they are the same number, but the one-time reset that happened, and we have been reiterating several times, is actually a one-off, and it's existed for historical reasons, which has been bridged. And so going forward, the parity is largely there, which should not result in a big risk of a big yield reset from any of the customers.
The next one is from Nidesh Jain, Investec again. What is the revenue model of Bima Central Administrator?
So like we said, Bima Central Administrator, think of it as opening a large pipe between us and the customer, but that pipe travels through the distributor. It travels through the distributor. So the distributor is the aggregation agency. How will this work? The charging mechanism will not change at all, which means a distributor comes in, brings in, let's say, 10 lakh policies, and brings in, let's say, 10 lakh individuals. We open EIA accounts for all those 10 lakh people. We charge for the account opening to the insurance company. That's how it is charged today. That's how it will be charged then. We then charge them for maintenance of these policies for all future years. And when transactions begin to happen, when these 10 lakh people pay their first premium, or maintain the metadata, or do KYC or re-KYC, or file for a claim, or do a digital lien, again, on that transaction, the charges will be charged. Again, not to the broker, because the convention has been that all of this is being done for the individual and for the AMC. The AMC is the commercial buyer. So not the AMC, sorry, the insurance company is the commercial buyer, so the insurance company will continue paying for it. So Bima Central Administrator, therefore, is a large pipe which opens up our ability to access those very large pools of insured people and opening up EIAs. The charging of dematting of policies, opening of EIAs, annual maintenance, and transactions will continue as it is. That doesn't change much. And all of those charges will devolve like they devolve today on the insurance companies.
Okay. The next one is from Somil Shah, Mosaic Advisors. How did we win C-Bank mandate in Sri Lanka when we don't have any intent to go international?
It's like a friend of you who sends you a birthday cake, right? You never ask for it. These cakes do come from time to time. So I can tell you that even today, my belief is that almost 40 to 50% of CAMS's sales is inbound. It's inbound, it's a referral. Those two things, which means although we built out a large workforce today, I have at least 25, 26, maybe 27 people who are quota carrying and who are hunting and who are knocking on the doors of customers. Almost half of our sales happens because clients want to be with us. We are not pushing them, or we are not kind of making an intense bid. C-Bank was actually, Ian is the CEO. I just met him in November when I made a trip. He dropped me a LinkedIn invite and a message in Jan of 24. Jan of 25, we signed a deal. I had never met him in my life, either before or till then. The team had met them a few times, so it was a pure inbound. We continue to get inbounds. It is just that this inbound was from overseas, but we continue to get many, many inbounds.
Okay. The next one is from Nikhil from Kotak. Question is with reference to Bima Central. Isn't the Bima Central a threat to disintermediation of the distribution, as insurance is such a push product in India? Does the platform have anything to offer as comfort to the distributor?
See, it's a good question. It's a good question, and I will not pretend that I have an easy answer. Distributors of all kinds, whether it is insurance or MF, or any third-party product, have continued to believe for a long time. It's going away, by the way. The numbers will tell you it's going away. Have believed in asymmetry, have believed in paper more than digital, and have not believed in platforms too much because they believe that data becomes visible to everyone else. If that entity wants to communicate with the investor directly or the insured directly, they can. And on the other hand, the insured can learn how to start working on that platform. So all those things exist even today. Despite that, you have seen that a lot of distributors in the MF world have moved to platforms. They've all moved to platforms. We run a platform, H360. Exchanges run their platforms. You saw this entire thing about FundsNet. All of them are platforms. And a lot of them have moved to intermediaries. We believe that the slow offtake of DMAT was the first manifestation that distributors were not very keen. However, we are not talking of the small going on the scooter or going on the bike kind of distributor. We are talking of large corporate entities spawned by very large corporate groups. Every car manufacturer in this country has an insurance distribution company. Very, very large corporates have. So this demand is coming from them. They have a level of maturity and understanding. CAMS also, I must tell you, is perhaps the most non-threatening entity in the entire market, because whatever be the inducement, the market knows that for the past 30 years, CAMS has never tried to sell anything to that consumer. Neither through surrogacy, nor through any clandestine means have we ever sold a rupee worth of product to anyone. So people have that comfort. These are large entities who have that understanding. Has the resistance gone away completely? The answer is no. Is the convenience going to offset all the resistance? We are hoping it will be. You will have to watch the space closely for the next 3-4 quarters for us to get to the exact answer.
The next one is from Anshuman from ISEC. Can MF start having some edge with AI? Can CAMS harness AI more effectively than MFs?
If you want me to hire more than 200 people that I have on AI, I'm not going to hire them because we have enough. If you want us to get more people like Google, we are not going to do that because we have enough. I think for us to give more artifacts and to vindicate this belief that we have done enough and more, it is, I think, after whatever we've shown you today, whatever we talked to you in our earnings calls, and we meet you guys in conferences and in meetings. I do at least over 100 meetings. That's one. central theme. Now, are the MFs doing AI? Certainly they are. Obviously, they have the money, they will do this. Are they doing it in these areas? Not much that I know, but they will try to profile customers. They will try to do several things on the product and customer side. We are optimally placed today. We have the best partnerships, we have the best expertise, we have the best talent. And I see that most closely because a lot of people in the ecosystem are trying to hire my people, so I know what's happening. So today I think we are very optimally and very well placed. Show me one conference that you've gone to where you've seen the product suite of the kind that we have shown you. And none of this is gimmickry. None of this is gimmickry, none of this is lip service, none of this is stuff that I made 5 Figma screens for this meeting. We've done none of that. What we will do is that for all of these products, we will do a follow-on session with you. Is Sumandu here? Maybe CAMSLens we should open out for this audience maybe in a week's time, so that you can tinker with it yourself. And do keep coming back. We watch all the PR done by every global entity in the capital markets. Name a large stock exchange, name a large depository, name a large intermediary who's making similar announcements. There may be one or two, but they're not too many. In India, hardly any. So that's where I'll leave the topic. I think what Ram said was very perceptive, that when we pay a 65% dividend, a lot of people say, oh, look, oh, you're giving so much money, why don't you keep it with yourself? A lot of this money has been spent. That 660 number has scaled to a 1200 number. That's real investment. We have hired from the NITs and the IITs quality engineers. We are happy to host some of you. And people like Abhijit must find the time next time to come to the center and look at those people. The question was from Abhijit, right?
It was from Anshuman.
Oh, from Anshuman, okay. So people like Anshuman must come and meet those people. So that's the evidence that I want to place on the table for your consumption, that we are more than optimally placed. We are not just tinkering. This is not lip service. These are not Figma screens. This is real, clear work, which is about to unleash itself. In our entire data entry process, we are about to take out the maker from one kind of redemptions. And I can tell you that in the mix that he showed you, there are 800 data entry people. Slowly, we will phase that activity out completely because we have the means now. We've been doing it for some time. Do we want to oversize it any further at this point? No. I think we have several fronts open. We will fight the battle on those fronts and keep it where it is. You want to add something?
No, this.
So while we have some more questions in the bag, should you have questions, feel free to scan the QR and ask them, and we promise to answer all of them. Maybe Pranav can have the QR on the screen just for people.
Take questions.
If you want to give them, pass on the mic for direct questions.
Yeah, there are a few more in the bag. So
okay.
Let's finish this first. Next one is from Chandrasekharan from BPFA's MF, and this one is on ID2Pay. Could you throw some light on how would the business model be? Will these devices be sold or rented? How would you monetize this? Fixed rentals or transaction driven? Will this be for just distributors or for the AMC's own RM teams and service branches?
Okay. So in whatever order, just want to tell you that while this idea has been in our minds for a very long time, we are trying to be extremely careful about not latching onto a device which can be misused in the markets. People who will be accessed perhaps don't know much about capital market products. You keep hearing about UPI and QR code fraud every day, all of us. And therefore, our theme has been that we will create something which will open up new segments in the market, but only have credible means to access those. The most credible means to begin with, and we will see, let's say in the first year how this goes, is to enable AMCs. And AMCs are expressing interest. They are saying, look, I am okay to hire a team, or if they are spawned by a bank, to have the bank teams access these people, just like we open salary accounts and just like we go to markets to open current accounts. We are happy to do this process. So you will see the start with asset managers and their employees and their teams and their RMs. That's starting. Some large intermediaries and brokers with a reputation who have large teams, that will be our next stop. And depending upon how these two steps go, you will see us move further and further. How will this work? Remember that the KYC will be done on our platform, so we will be paid for the KYC. The NACH will be filled on our platform, so we will be paid for the NACH. The transaction will originate on our platform, so we will be paid for the transaction. The assets will come to us, which hopefully will stay with us for life. The customer will stay with us for life. The device, therefore, needs a pricing mechanism, which most likely will look like a monthly rental. That's the belief with which we are going in.
The next one is from Kanchan from CNBC Awas. What's your take on regulatory risk of lower fees?
I will say only one thing, and I've been saying the same thing for many, many years. That from a fee perspective, what the customer gets, so what they buy and what I sell, is the lowest fee point in the market anywhere in the world, including in India. If you find a lower fee, I am happy to engage in a conversation with whoever claims there is a lower fee. How does the math work? The math works like this. Today we have just short of 11 crore mutual fund accounts with balances. I am not tainting the picture by bringing in zero balance accounts. So I have 11 crore serviceable accounts. I have a 1,300 crore book of MF revenue. Although I sell as bips on asset, that's a pricing model. If I divide 1,300 crore by 11 crore accounts, I'm selling at 120 rupees per account per year. What do you get? What does the consumer get? What does the AMC get? And what does the marketplace get? You get unfettered access of all your investment on MyCams or Camps Online. You can be an RI, you can become an NRI, become an RI again, have TDS, no TDS, submit a 15H form, put your assets in lien, borrow monies against it, give us a POA, take the POA back the next day, come to our physical centers for a statement every day. We will do it for you. Today when you compare, all of you have demat accounts, just compare, go back and look at the debit in your accounts on what you're paying. And that's perhaps the closest example. It's not outsourced like our model is outsourced, but outsourcing has led us to where it is. Insurance will be expensive, banks will be expensive, but inside of demat, most of us are paying 200, 250, 300, 350 rupees a year as maintenance charges. When shares come in, you pay some money. When shares go out, you pay some money. And then for ISIN creation, for corporate action, for BenPOS, everything is paid for. There's a single fee. We run the entire industry between the two RTAs, selling at this price point. If you find a cheaper model, let us know. So that's the preamble. Now, am I the only guy who knows all of this? Am I hiding this from the rest of the world? No. My words remain the same, my lines are the same, whether there's a regulator in front or the industry body or a client of ours or a foreigner or whoever it is or a journalist, we say the same thing. This is the cheapest model with the widest span of services anywhere in the world. If you find a cheaper model, bring the guy to me and I'd like to have a conversation. Now, do regulators want to drive this price down further? I think as a headline, everyone wants things to be cheaper, but we've not ever had a conversation with the regulator on whether we can sell these things cheaper. You will find, for example, there are instances where the industry believes that KYC charges, let's say for छोटे SIP can be lower, KYC charges for lower size investment, those kind of things can be cheaper. Those dialogues we've learned to live with. I think we will live with them all the time. I do not believe that regulators are uncomfortable in any way at the existing price points. Just like we take credit, they take credit that this is the most efficient delivery model which exists either in financial services or outside in this country or anywhere.
The next one is from Niranjan Avendes Park, and this one is for the KRA business. What is the threat of central KYC, and is there any risk to the current pricing in the business?
You see, unified single KYC has been a theme for many years. It's been spoken about in the most exalted forums in this country, and it will be a convenience. It will certainly be a convenience if it were to happen. So that's the good part of it, which you've read and I've read. KRAs today have built a structure which is significantly embellished. There is a real gold plating on how the business is run. And I don't think alternate mechanisms are there. They're trying to get there. They may get there after a few years. Today, they don't have it. KRAs take your information, but they do independent verification of everything. They'll match the face, match the father's name, match your date of birth, take data from Aadhaar, take data from DigiLocker. They'll make a full comparison before we store it. We sanitize it. We guarantee the outcome. Today, the KRAs are the first one, give credit to SEBI, that we are the first ones to invent a mechanism where there's a daily demise reconciliation. These 17 or 18 crore people who either have mutual fund accounts or depository accounts or broking accounts, if one person passed away yesterday and their next of kin told any stockbroker, any one of us in this entire large ecosystem, that information travels back to the KRA instantly through the intermediary. The KRA will send it to all the other KRAs. Those KRAs will send it wherever that PAN exists, whether it's a MF or anywhere else. These are efficiencies which do not exist in the rest of the world. So therefore, we do not think, also the artifacts inside the KRA are admissible under the securities law in India. That's not how the law is constructed to scrap this and start doing those things through, let's say, some other alternate form of KYC. So there are multiple angles to this involved. It is a dialogue that you've read about and I've read about. But we believe that this model, again, it's pure value delivery. I'm not trying to protect any turf which is unprotectable, because you can't do it for 10 or 20 years. You can do it for 1 or 2 or 3 years. It will not last a lifetime. We believe the KRAs have done a fantastic job under the guidance of the regulator and the industry to create a utility. You see, I mean, all of you are in your systems, I can see. If you Google right now, name any private sector bank that you like, you will see reported 500 to 1,000 frauds in a year. Reported. It's on the internet. You can do it right now. You come to the MF industry. We own 68% of the market. We do not report maybe even 20 frauds in a year, not more than one in a month. This is because of extremely clean data, extremely large business controls, no lip service, untainted deployment of the regulatory intent, right? That's what it is. So I do not think that a device like this or a mechanism like this can be deselected in a hurry and somebody else can start copying it at scale. They will have to do it for 110 crore Indians, because those are the number of people who own bank accounts. Doing that is going to take many years. So that's our belief. Is there pressure on KRA pricing? Like I said in the past, for small formats, etc., it has been said many times. We do offer, we are part of the industry, we eat of the same plate. So we have offered friendly pricing many times. I have never seen that pricing has ever got in the way of our business growth. Like Ramcharan said, and he used a very nice line, that all this has happened with good years and bad years, price remissions, scope expansion, all of that, the lines we've shown you on PAT and EBITDA and revenue growth and non-MF revenue growth has happened after. It's not that there is no winter and I have spring all the time. We've seen winters ourselves. That's how I would answer your question.
The next one is from Devesh, IFL Capital. This one is on REAC. Is the central idea to come up with the new solutions as shown today for the platform to deliver higher value for the customers, or would it help to optimize cost or improve margins? If it is to help to optimize cost and improve margins, what is the cost that you would be incurring over the next 5 years and the benefit that you would accrue in terms of margins and accretion?
So, specifically, obviously, this has been budgeted and we have gone through the numbers in detail, and this has been running for the last 1 year, right? So when we started doing this project, the estimated cost, and when I say estimated cost, I mean the capex as well as the opex put together was close to 500 crores, right? And so we've probably spent around 70, 80 crores of that. So we will end up spending over the next few years 100 plus crores on a yearly basis. Out of it, 60 plus crores will be on the platform before it goes live. That's kind of the capex. So from a depreciation perspective, you will have a very muted impact, probably less than 10 crores a year, and then going forward probably another 10 crores, etc., because you amortize it over a period of 10 years. But this is a significant spend. In the overall scheme of perspective, there will be some increase in spend that happens because of cloud cost. There will be increase in spend because of different other expenses. We do have high cost resources working on it. But there will be a lot of offset also. The offset is on 2-3 aspects. Number one is we don't need to buy the current IT infrastructure that we are buying because we are fully on the cloud. So they'll be retired as we go along. Second thing is the process, as you saw, and what you saw was a sample. This is by no stretch the entire re-architecture, right? What you saw was a sample of a few processes that we picked up for automation. There are several more that happens, which will cause a lot of optimization of effort. So the numbers, to cut a long story, the numbers we have done show that in the time where there is an overlap of platforms where we, because being risk averse, we run both the platforms until all the modules go live, there will be an overlap and there will be a cost increase. But our working show the cost increase would never be more than 0.5 to 1% of the margins. which the optimization that happens as we go along should be able to take care of. So for us, the scenario that we are painting is that till the platform fully goes live for the next 3 years plus, we do not see a negative impact on the margins. And post that is when the real benefit will kick in terms of you won't have the overlap, you will have the fully new React platform, you will have the entire benefits flowing into that. At that point of time, whether this is going to significantly reduce the cost, our expectation is it is. But it is 3 years down the line. So I will not give you a number and say my margins will become +3, +4, or cost will come down with -3, -4. But you can be rest assured that once this goes live, there will be a significant reduction in cost, which should flow to the bottom line.
Okay, maybe we'll take a couple of live questions. I have a few more questions in the queue, but maybe Pranav, anybody live question? If you can just introduce yourself and ask your question, please.
Hey, hi, this is Nikhil from SOAM AIF. So just wanted to thank you for the detailed presentation that you have given. Just wanted to understand that you have been maintaining your leadership position with 67-68% market share. So when it comes to alternatives, what kind of right of win do you have? And in the SIF also, when you mentioned that the market size is around, the opportunity size is around 5 trillion in that sense. So especially when the competitor is also trying to gauge the market share in alternative business. So what's your right of win in that business?
See, markets buy capability. They buy capability at the right price. In outsourcing, you have to be very clear. And the reason we've been placing accent on this word trust is that they trust you with the family silver. This is not the outsourcing that Boeing does to IBM or somebody does to Accenture, because they have 5 backups and 3 continents in which they are working, and scope is splintered. Here, scope is not splintered. Everything is with you. Over the last many years, we remained an undiversified group. This was a founder-led company. The founder chose, he obviously knew, and a head-to-head competitor was doing this, that they were setting up stockbroking companies, wealth management companies, metal trading companies, advisory companies. We set up nothing. It wasn't because we were dumb or stupid. At that time, I wasn't in the company. The founder didn't want to do anything. Just to exhibit to the markets that our entire focus is on them. You play in a niche, but you play like a leader in a niche. At any point in time, it should not take anyone 1 month to meet the CAMS founder or the CAMS CEO. That was the stated philosophy. When I came in, especially after we got listed, we are diversifying now. So you saw a lot of revenue diversification themes, but we will remain a domestic company. I get asked this question every day, and my answer remains the same, that we believe India domestic has driven this 26% non-MF revenue growth, 17-18% overall franchise growth, 18% PAT growth. It will continue doing all of that. So our right to win comes from the facts that we are focused. We were single product, we are multi-product today, but we're extremely focused. In the face of temptation, we're not doing things just because they're fashionable or just because we can write a fancy report to investors. Our offering is superior. Whether it is tech, whether it is customer service or distributor service or document retention or just anything that you ever have to kind of use in this entire segment, the capability is superior, which is established. I showed you a very small thing called the complaints ratio, but we can show you a dozen things which establish that we have a superior capability. So we have a right to win. In the last maybe 15 years, apart from Axis and Bajaj, there haven't really been bids that we wanted to win, that we did not win. Bajaj was in 21, 22. Axis was probably 10, 11 or 12 years before that. Other than that, we have what we have. You are seeing a slew of new AMCs come in. Not everybody will scale to the extent possible. You've seen subscale franchises even in the past. Subscale can continue and the competitiveness is going up. Today, for an MF to create a competitive product against legendary fund management capability is not going to be easy. Unless a legendary fund manager is setting up that MF. Those legendary fund managers are not even 10 in number. So we will see when those 10 come to the market. Other than that, there are PMS guys who are diversifying, who want incidence of tax to be kind of easier for their customers, or brokers who believe that this is a nice hedge if broking goes into a freeze or goes into a winter kind of phase. So we believe that we have the right to win everywhere. SIFs, you need a MF license. Pure SIF only MFs haven't happened. One or two of them will happen at some point in time. For everyone else, there's a diversification. So today, our clients have been trying to keep their lives easy. Our clients say, and for their benefit, because they don't want to create superstructure and organizations and administrative organizations of large size, they say you do everything. So can you do KYC? Of course you can. Can you do payments? Of course you can. Can you do AIF? Of course you can. Can you do SIF? Of course you can. And you can do MF, and you can do consenting and whatever else you have, including account aggregator. They want a one-stop shop. If somebody has to escalate, he only needs to know Anuj Kumar's number. He doesn't have to go to 6 people or 10 different providers. That's one thing that this clientele is buying. It's unblemished, it is clear, and I don't think it's going to change in a hurry. Because the MFs themselves say that today for them to keep cost of operations where it is, just imagine, your average TR BIPs will be like 150, 160, 170. Your PNL BIPs will be probably 50 to 60, maybe higher. And your RTA BIPs are 3 or under 3. So compare a 180 BIPs TR with a 3 BIPs RTA service to see how efficient it is. Tell me which other industry you see this in. So that's what gives us right to win. Of course, it's a competitive market. Sometimes price becomes very important. Sometimes something else becomes very important. But that, I think, is a fringe case. Like I told you, the reason we showed you 190, what did we show? 190 wealth serves growing to whatever, 250, 260 in a year, 160 going to 250, is not because I have too many salesmen. Like I said, half our sales is inbound. Customers want to come to us. Of course, they will not come into my building and start shaking hands. We have to have a sales force, we have to have a bid mechanism, we have to be competitively priced, we have to negotiate, we have to do all of that. But half the clients who come to CAMS want to work with us.
Okay. The second question
Hi.
is that you have been mentioning that the AMCs, larger ones, they are done with their negotiations when it comes to their TR and all those things. Do you envisage they coming back to you and when because of the TR regulations that are going on?
So the TR, I think all of us would have got ourselves familiarized with what the revised CB is, and it's kind of a much lesser version of what initially was proposed a few years back. So what it means is two things. One is you have a 5 bips taken away from the TER because of the sunsetting a particular provision that they had. Second thing is from a GST perspective. This is outside the TER. To compensate that, there's a reduction in TER. So if you actually do the actual math, okay, and we've done the actual math, you do the actual math for all the AMCs depending on whatever their OPEX is, whether their management fee is, you will find that the impact, barring a few AMCs, is non-existent. It's non-existent. For a few AMCs where there is impact, the impact is muted. Now, within that muted impact, say it's 3, 4, 5 bips within that range, will they come to the RTAs and say you take a part of it? Uncertain. We don't know. Nobody has asked us anything so far. No conversation has started. Will they go to other stakeholders? Probably. A couple of the listed stakeholders have said that they have been approached for this. So the takeaway is that if at all there is something that happens, and conversations may happen in the future, none has happened so far, or it could be bundled as a part of the next renewal that happens with them, whenever that happens, 1 year from now, 2 years from now. Even then, the impact is going to be very muted, right? You can do the back of envelope calculation, you do your fund accounting, we have done the fund, we don't want to give a number, because when you give a number, you latch onto the number and say what happened to that from next time. But you can do the calculation yourself, it's going to be extremely muted, right? And it will be well under control, and we will absorb it within the overall 3% that we are speaking about in terms of yield depletion.
Okay, thank you. Those are my questions, and best of luck.
Thank you.
Hi, this is Anil, and I cover personal finance at the Fine Print. First of all, Anuj, congrats to your team for having the fantastic track record. I personally use CAMS ever since I've started investing, and I tell all my friends who use CAMS. My question to you is, this platforms like Grow and Coin became popular. My question to you is, how do you see platforms like ONDC platforms like Cybrella, bringing the transaction cost at a very low price? Do you see that as a competition? What are your views on this?
Not yet. And we haven't seen any momentum build in. ONDC, of course, is a fantastic innovation, is a fantastic platform. But for the mutual fund investor, I think it's perhaps a little late. Most of them are not experimenters. Just remember that unlike how you order food online or order grocery online, here it's also a question of how you monitor your portfolio. You want to see it in a certain way. Your returns are computed in a certain way. All of that is important for you. So I have seen that most people get used to a certain platform and then they stay with it. Individual users are not paying for any of these things. As you know, the individual user pays for the TER, and that TER is based on several dynamics, including transaction cost. But like I said, 170, 180 TER, the whole cost of operate is under 3 bips. So you have a 180 TER available to the mutual fund, but what ends up being spent on the cost of operate is under 3 bips. And therefore, are they individually driving economies? Not really. Are they looking for ONDC to bring in a lot more customers? That can be an inducement whenever ONDC does that. I think it's very early days right now, and I do not see a mention of this theme too much. Very little.
Thanks.
Take one question from the queue and then come back here. This one is from Swarnab, BNK Securities. Given new MF journeys starting, how should we think of operating leverage in core MF business over the next 2-3 years? While operation headcount in MF might not increase, we see tech cost and manpower increasing. How is this apportioned across businesses, factoring the tech re-architecture?
So if I understand your question, Swarnab, this is more to do with over the next 2 years. So you're not talking about the post new platform. So what we see is that when I tried to break out that cost for you, it was just to prove that technology investment. The margin competition is entirely different. Obviously, there is a cost of technology for mutual fund also. This was more an attempt to show you how the headcount has moved. So from operating leverage perspective, nothing changes, right? Nothing changes over the next few years. We still continue to work on, it's not as if we're waiting for the new platform to go live and sitting tight and doing nothing on the old platform. We continue to have automation done on the old platform. We continue to optimize processes. We continue to kind of do what we need to do in terms of all these things. So, that in a good quarter, we still say that if it's a good quarter, then 55 to 60% at least of the incremental revenue flows to the bottom line. We continue to hold that view that in a quarter which does not have a big yield reset or a big cost inflation because of salary increase, we'll continue to have the 60+% of the incremental sales will flow to the bottom line. From a structure perspective, nothing changes over the next few years. What we are saying is post the REAR going live, that could be accelerated. That could be accelerated in terms of the operating leverage. But I think as of now, what you see in the last few years is what you will see in the next few years also.
Okay. Sorry, one live question? Okay, till that builds up, I'll ask the next question. This is from Lalit from Equidis on the KRA business. What will be the share of revenue coming from non-MF segments, and where do we see the share over the next 3 years?
Anish, you should answer that question because he runs the KRA
But I'm
business.
moderating this now, so maybe I'll let you do that.
So the question is non-mutual fund business.
Yes.
Okay. So as you know that a few years back, it was almost like zero. We are catering only to the mutual funds. So over the last few years, we have signed up a lot of intermediaries, including 2 of the top 5 brokers. Our estimate is in the current quarter, we will at least get close to, Anish, 30-35% of the revenue from KRA will be from non-AMC mutual funds kind of a business. And that share will keep increasing as we make more inroads into the broker community.
Okay. The next one is from Niranjan again from Avendus Park, and this time it's on the payments business. If mutual fund business is excluded, which sectors are contributing to the growth?
Is that the question?
Yeah. Apart from mutual funds, which is the other segment in the payments that's contributing?
I think Anuj also said that in his presentation, right? Now, of the revenue, we said almost 15-20% is coming from cards, and card business is predominantly insurance, right? It's predominantly insurance. There is some amount of account validation that's happening in LIC. So if at all you want to point out something apart from mutual fund, I would say insurance sector is a very fast growing sector for a payments perspective.
Okay. The last one in the queue I have, and maybe if we have live, you can take. The last one in the queue is this is from Rohan Nagpal from Helios. A capital markets infrastructure player has expressed concern that the further margin expansion could invite regulatory scrutiny. Given where you stand in terms of profitability within the Nifty 500, do you feel similarly?
Yes and no. Yes and no. So it's a fact that there is a thin line between profit making and profiteering. High percentage margins can lead people to conclude there's too much money, even if it is all created by us and we have built efficiencies over years and decades. In a country like ours, it will be questioned by someone at some time. So yes, I would say I don't disagree with you that percentage profits can bring people to that conclusion. However, you've also seen that we made investments in the interest of the business because a lot of them are allied spaces. We're not trying to do something dramatically different in a dramatically different country. Is to improve the entire ecosystem, building whatever we are building. So those investments will continue. Is it our desire to be a 50 or 55% EBITDA company? The answer is no, it is not. We believe that we are optimally placed from a percentage margin perspective. If we can create revenue growth and create about 1% of operating leverage every year, I think we will be very happy at the company level and our investors will be happy. So take that as a broad outlook.
Okay, so do we have any more live questions? Anybody? I hope I've read out all the questions that were there in the queue. If not, you can ask them here as well. Yeah, can we have the mic there, please, Pranav?
Hi, my name is Nidhesh from Investec. My question is on, there has been some talks of fixed fee structure on the domestic mutual fund business. So is that true that mutual funds are talking about fixed fee structure instead of linking to AUM? And if that happens, how are, let's say, margins, etc., will pan out?
I have in my 10 years never had this conversation. I think it's very unlikely. Neither BPO nor IT services, no comparable arena has fixed pricing. So fixed pricing is obviously not an answer, will never be an answer. And I don't know whether our shareholders will ever be supportive of these kind of mechanisms. So there's never been a conversation with me on this.
Sure.
We don't think anything like this is on the cards.